Hello and welcome to BQ Prime. Joining us today is Mr. Rohit Anand, CFO of Mahindra. He's joining us after the company's Q3 results, where revenue and profit have met estimates or beat estimates, have beat them as well, whereas deal activity has been robust. So, sir, in a post-earnings call after your Q2 results, you had said that there is geopolitical overtures are yet to creep into client spending. So, after Q3, what are you looking at right now?
Yeah, so I think when you look at the current quarter results, from a sequential quarter-over-quarter basis, looking at last 2-3 quarters, you'll see the growth overall has reduced. Right? What we were seeing quarterly sequential. In the current macroeconomic scenario, we've still marginally grown. But as we move forward, I think that sequential trend will continue to play out, right? And I think it is varied between Europe and US as a geography. The rest of the world looks pretty robust in terms of demand environment. And I think that trend for us requires closer monitoring as we move forward, because while the deal closures are still good, the decision making overall is a little bit more slow than what we've seen in the past, and hence as we move forward, being ready for that demand, which is uncertain, could be moderate, could be high, could be low. We just need to be ready with that, and that's why CP already spoke, and we're working towards a very agile response system so that we can react to the demand environment versus inflating our costs in that proportion.
Okay. There's something you also talk about, the portfolio pruning exercise. So it has already happened in Q1 and Q2. You said that it will continue in Q3 and Q4.
Yeah.
So how has that impacted your margin in Q3, and where do you see it going in Q4? In respect to that, are we on track to also meet the guidance of 14% EBIT margin for the entire fiscal?
So first, on the pruning of the portfolio, yes, we started taking action on that. We did see an impact last time. We have a very marginal impact this time, not significant. But the pipeline of that kitty is still very active with us to take actions on, and not just this quarter. As we move forward, we'll continue to act on it. And I think it's the right thing to do from a portfolio standpoint. And that will definitely impact the margins as we move forward, because from a mix perspective, that will be a low margin or a lower than the portfolio. Right? So that will continue. I think in terms of our EBIT margins, as we said a couple of quarters back, we hit a bottom point. We continue to expand margins. We've continued to do that. From that point to now, one change that has significantly happened is the demand environment has shrunk from what it was. In an accelerating demand environment, in a growth view, where sequentially quarter growth is high, delivering margin actions are relatively easier versus when you're in an environment where the growth becomes a little challenging, because some of that is also function of growth. So I think from our perspective, our view continues to be same, that we'll continue to expand margins and go in those operating actions, driving margin expansion.
So you will meet your 14% EBIT margin?
No, I don't think we'll commit any number to it, but we are at 12%. So in a quarter, I think given where the macro environment is, I would kind of either ways comment on it, but we'll make sure that we continue to drive actions. That's where we are.
So coming to your total contract value, surprisingly high for this quarter. Where do you see going forward? Is it a sign of a slowdown coming to an end? I mean, Mr. Gurnani had spoken to us earlier in Davos. He had said that the next few months, next few quarters are crucial. So now it has gone up to $795 million. So now what do you see? Are you expecting higher than this in Q4 and the scenario for the rest of the calendar year?
I think the deal flow and the pipeline, as CP mentioned, looks to be strong. I think from a conversion standpoint, we are still talking about that range of $700 to $1 billion. I think that range continues to be valid for us. Unless we see a significant slowdown, we'll update that number. But right now, I think that range continues. From a flow down of that to revenue, I think that scenario has diluted a little bit, because a lot of current customers, not just the new deals, their existing spends and their continuous upgradation of spends, which typically happen outside of non-deals, have tightened, right? Because their budgets have gone down. That growth adder is reduced significantly, and hence the revenue continues to see pressure. So I think while the deal wins is robust, the revenue growth seeing an impact because of that factor.
Just one last final question. What is the impact of the currency fluctuations and the furloughs on the results? Just a quick.
I think from a currency standpoint, the reported growth, as we mentioned, is 1.8%.
Okay.
Currency adjusted growth is going to be 0.2%.
Okay.
So we got a benefit. Last time we had a other way impact. Furloughs, as we mentioned, typically Q4 is a high furlough quarter. We see an impact close to 1% of that. This time, the only other adder is that the furloughs are continuing slightly into January as well in certain regions. So we'll continue to monitor how that pans out.